Hello, welcome to our new video on manufacturing accounting. There is a lot of information about accounting of inventory, how accounting works for inventory in general, but there is some gap in information when it comes to manufacturing accounting, how accounting works on ERPNext for manufacturing companies, what are the kind of entries made, what does it mean, and I'm going to try and cover all the FAQs that I usually get from customers and clients when it comes to accounting specifically for manufacturing. Right, so let's dive deeper into it. So first of all, let's just try to understand what profit means. Profit is nothing but your sales less the cost is nothing but your profit, right? Simple. Yet there are certain accounting nuances involved in it, so that is exactly what I'm going to try and explain in this video. So when it comes to accounting, there are certain accounting principles that one has to follow, and the software is also expected to follow those accounting principles. So one of the main principles of GAAP, US GAAP or IFRS is matching principle. So what does matching principle actually mean? So matching principle means that the cost that you book in a given period, let's say for a year, should be only for the value of goods that you have sold, so that you don't end up over reporting or under reporting your profits, right? So for example, let's say I'm setting up a new manufacturing plant. I have good sales that year, but since it's the first year that I'm setting it up, it's possible that I've spent a lot of money in manufacturing goods and setting it up, and a lot of initial expenses are expensed during the first year. Therefore, it happens that my cost during that year is higher than the sales that I made. But the next year, since I already had a lot of things in place, and also I had some goods that I could sell from the previous year, my cost reduces, right? So what happens is you end up reporting loss in year number 1, and you end up reporting a lot of profit in year 2. So what matching principle tells you is you should book the expenses only for the goods that you sold in that year. So that is a very layman explanation of matching principle, yeah, so that's what matching principle means. Now let's get to costing. So when it comes to costing, there are multiple concepts that one needs to understand and be aware of how it maps in terms of ERPNext. So the first concept that I want to explain is cost composition. So what does cost composition mean? So cost composition means what will your cost comprise of, right? What kind of expenses are you going to include in the costing of your product? So there are two main concepts that we need to understand. One is product costing and the other is period costing. So what do we mean by product costing and period costing? So the name itself is pretty explanatory. The cost that you include in the costing of your product that you're manufacturing and eventually selling is nothing but product cost, and the cost that you're not including in your product and you're including it as an expense that you incurred in a particular period at the company level and not at the product level is period cost, right? So when it comes to cost composition, there are two main types of cost composition that is usually used in the industry. First one is variable costing and the second one is absorption costing. So ERPNext uses absorption costing because it has the ability to do so, and also it is GAAP compliant. So according to GAAP, you need to use absorption costing because it complies with the matching principle, meaning that the costs that you incur are capitalized into the asset value or the value of goods that you produced unless and until you sell it. So you may have incurred that cost before you actually sell it, before you are able to reap the sales value of that cost, but you have to include it in the value of the goods, right? So those are the main two concepts when it comes to cost composition. So the only difference between variable costing and absorption costing is that the way it treats fixed manufacturing overheads. So if you notice here, in variable costing, fixed manufacturing overheads are treated as period costs, whereas in absorption costing, those are treated as product cost. So what is exactly a fixed manufacturing overhead cost? So things like rent. So for example, rent is a good example for fixed manufacturing overheads. Whether you manufacture goods or you manufacture a certain less quantity or more quantity, these are your fixed manufacturing overheads that you have to pay regardless of whether you manufacture less or more, right? So those are what we categorize as fixed manufacturing overheads. So absorption costing recommends that you absorb the cost like rent within your product cost, apart from variable manufacturing overheads as well. And obviously there is direct material cost, direct labor cost as well, that needs to be included in production costing. Then there is another concept called cost measurement. So what cost measurement refers to is how are you measuring the cost? How are you measuring your direct labor cost? How are you measuring your direct material cost? How are you measuring your fixed manufacturing overheads, etc., right? So as we have already discussed, ERPNext uses absorption costing. So in ERPNext, direct material cost is nothing but your raw material cost that you are using in order to assemble or manufacture or produce certain finished goods. So that is used based on actual costing, meaning that it is either using FIFO, moving average, or LIFO in order to get the raw material costing. And then when it comes to direct labor cost, it uses actual time spent by direct labor, but the per hour cost is used on an estimation basis, and therefore it can be said that the per hour cost is a standard costing methodology that ERPNext follows. So as you can see, for the direct labor part, ERPNext uses a hybrid of actual costing of time, because it uses actual time that the workers or employees spend on that manufacturing that particular finished goods. But when it comes to per hour cost, it is an estimated cost, because the cost can vary for multiple reasons. Different employees may have different hourly cost and many other reasons. And then when it comes to other overheads like rent, electricity cost, for that as well, ERPNext uses actual time, and it uses a per hour cost based on an estimation basis, right? So those are the concepts that you need to understand when it comes to costing. So this gives you an overall idea of what kind of costing measurement, what kind of costing composition is used, what is the stock valuation that ERPNext uses. So now moving on to the next part, which is work order. So work order is the main document, is the origination, I would say, of the manufacturing flow in ERPNext. So the usual flow for a work order on ERPNext is you create a work order. It can be either through production planning, or it can be created directly through a BOM, an item. There are multiple ways to do it. But ideally it is done through production planning, because it lets you do raw material planning as well. So if you go to the work order, once you create a work order, you'll see an option to start the work order. When you start a work order, what it essentially does is it will create a stock entry of type material transfer for manufacture, and it will transfer all the raw materials from store warehouse to work in progress warehouse. Once you have all the raw materials in your work in progress warehouse, you start assembling or you start working on it, you do whatever processes, operations you need to do on it, and that is recorded on ERPNext through job card. So for simplicity, I have assumed only one operation for this product, and let's say that is assembly. So you record the actual time through job card, right? So that's how ERPNext knows how much time was spent by direct labor, or how much time was used on a particular workstation in order to manufacture that product. So that is where this time component is coming from, and therefore I call it as actual costing when it comes to the time component of the total direct labor or the overhead cost, right? But the other component, which is per hour cost, is on an estimation basis, and the way you define that is on the workstation. So let's say this operation of assembly is happening on a particular workstation. So on the workstation, you define a per hour cost. So if I go to the operation and workstation tab, there is a workstation where this happened. If I navigate to the workstation, and if I go to operating cost, I have an option of defining the electricity cost, the rent cost, the per hour wages, and therefore what is the total hourly cost in order to operate that particular workstation, right? So that is the standard costing part of direct labor as well as the overhead cost. Now coming back to ERPNext, when you actually finish the work order, what happens is ERPNext will create a stock entry of type manufacture, which will consume all the raw materials, which is the direct material, as per the stock valuation method that you have defined on ERPNext. So it could be FIFO, it could be moving average, it could be LIFO, right? And if we look at the accounting ledger, the stock in hand, which is the raw material, gets credited, and the FG, if you notice, has an additional value. It's not just the $800 worth raw material, but there is an expenses included in valuation worth $120. So this is coming from the hourly operating cost that we have defined on the workstation. So ERPNext basically uses the time component from the job card and the hourly cost that you have defined on the workstation and arrives at an expenses included in valuation. So these are like operating costs that are included in the valuation of the finished goods, right? And therefore when you look at the accounting ledger, it will show you that stock worth $800 were consumed, credit means consumed, and then there is an expenses included worth $120, and therefore the value of finished goods produced is $920, right? So that is how the cost measurement works, and basically the value of the iPhone not only includes the direct material that is used, but includes direct labor, rent, electricity, everything within the valuation of the finished goods. So that's the process of work order, and how valuation is affected on the accounting part. So if we look at the accounting snapshot, so you'll see that when the work order is started, I've already showed you this all of this, but this is just a quick snapshot for a quick overview. So when you start a work order, stock is credited from store, it is debited to work in progress. When you finish it, it is credited from work in progress, and FG is debited along with the expenses included in valuation. At the time of delivery, what will happen is, so what I've taken in that example is 2 iPhones. I've manufactured 2 iPhones and the total is $920. So one iPhone is worth $460. So when you deliver it, COGS is booked at $460 each. So your FG stock gets credited by $460 and your COGS or cost of goods sold is booked for $460. So when you book the accrual invoice of that delivery, let's say we sell it for $600. So there is a debtor entry of $600 and sales or income is or revenue is recognized at $600. And then when you receive at the month end, let's say, just for simplicity, let us assume the salary expenses were $70 and then electricity expenses were $70. So what you'll notice here is the expenses that I estimated and included in valuation is $120 and the actual expenses incurred was $140. So that is how it would usually be, right? So what you estimate will usually not be what you actually incur. There might be certain variances, and how do we handle those is something that I'm going to cover subsequently in this video as well. Okay, so now coming to certain frequently asked questions that I usually get from my clients and prospects. So the first question that comes to everyone's mind is, if we are including the expenses of, let's say, rent or electricity within the finished goods value, are we counting the costing of rent and electricity twice? Are we doing it? I mean, are we accounting for it twice? The answer is no. Double entry accounting is like the accounting equivalent of Newton's third law. So just like Newton's third law, every action has an equal and opposite reaction. In double entry accounting, you cannot debit or credit a ledger without having an opposite or a counter entry of that particular entry, right? So therefore, every debit or credit that you do is accounted for. So you cannot go wrong if you're using double entry accounting. So when you debit stock, that's when you credit expenses included in valuation. So coming back to my previous slide, so when you, the first time, at the time of manufacturing, when you include the rent and electricity within the valuation of iPhone or the finished goods that I'm manufacturing, I am crediting expenses included in valuation. So this is like an accrual entry of expenses. So I am accounting for those expenses even before I incur those on an estimation basis, just to make sure that I capitalize those expenses, right? So that's when you credit it, and then when you actually book those expenses, you're debiting those expenses. So you are actually accounting, making entries twice, but that's the beauty of double entry accounting. It kind of nullifies each other. So if you notice, salary expenses and electricity expense of $70 each, so the total is $140, and the expenses that I included in valuation, $120, is already credited. So meaning that $120 out of these expenses is already included in the finished goods valuation, right? So I'm making entries multiple times, but I'm not counting the same cost twice, because I'm crediting it first and then debiting it the second time. Then the next question is, why are we crediting an expense account? So expenses included in valuation is effectively an expense account. The usual entry for expenses is you debit expenses, but why are we crediting it? So usually debits and credits by themselves have no meaning. There is no positive or negative connotation to it. They are only there for accounting purposes, so that you credit it once, then you debit it the other time, and therefore the net effect is the difference between debit and credit, and therefore we are crediting it only to account for it even before incurring it. So think of it as an accrual of expenses, provisioning of expenses. So you're accounting for it through credit and then debiting it when you actually incur that expense. So that is why we are crediting an expense account. Now, the last question that I usually get asked is, how do we book variances, or should we book variances or not? So what is variance accounting? So variance accounting is basically accounting for the variance between the estimated uh, expenses that is included in valuation and the actual expenses that are incurred. So if we look at the just the P&L part of that of the transaction that we have seen, if you notice that actual expenses is $140, as I've already explained, and the amount that I have included in valuation is $120. So there is a variance of $20. So it would make sense for me to book that variance in a separate ledger if I was using purely standard standard costing method. So coming back to this slide, if I were purely using standard costing method, so what standard costing method is, you're estimating certain cost and then you're booking those costs or expenses based on your estimation and not in sync with what is actually happening in reality, right? If you are doing that, then it would make sense to book my variances between the standard cost and the actual cost. But since ERPNext is using actual costing to a great extent and only using standard costing for per hour cost, it is essentially an actual costing method. Booking variances does not make sense since we are already using absorption costing method, meaning that we are already absorbing the indirect expenses within the valuation of the finished goods. If you want, you can make this you can post this journal entry and book your variance in a separate ledger, but it has its own problems according to me. It makes the profit and loss statement it doesn't look right. So right now the profit and loss statement, this is how it looks on ERPNext. So there is an expenses included in valuation, there is a credit, therefore negative 120, and there is an actual expense of 70 and 70 140, therefore the total expense is $20 positive, right? If I want to book my variance, I can do that through this journal entry where I'm setting off my salary ledger. So right now there is a debit of 70, so I'll set off that $70 of salary and $70 of electricity expense. I'll also set off the expenses included in valuation, which is right now credit. I'll set it off with a 120 debit and then just transfer the difference between these two in variance. So what this is telling me is that I under absorbed the costing by $20. That is what essentially it is telling me. But if I post this, I'll show you how the P&L looks. So once I post this variance journal entry, this is how my P&L looks. The only thing that I see on my P&L is the expenses included in valuation variance. I'm not able to figure out what is the amount of salary that I paid, what is the amount of electricity expense that I incurred, what was the amount of expenses that was included in valuation, because we've essentially offsetted those ledgers. So yeah, I think this is not the best way or not the best way to account for variance. If you want to actually look at variances, what I would suggest is avoid posting variance journal entry and actually look at the P&L. This actually tells you, okay, what is the variance? This tells you, okay, this amount of expenses were already included in the valuation, right? And then this is the indirect expense. So essentially the difference between EIV, expenses included in valuation, and the indirect expenses that you're posting on an actual basis is essentially your variance, which is this, right? So you don't really need to post that variance entry. And since we are using absorption costing, variance accounting does not really make a lot of sense. All right, so I hope that was helpful. That is it for now. If you have any questions regarding accounting or manufacturing, feel free to reach out to me. We'll be happy to help. Thank you.